Since its beginning in 2009, crypto trading has grown from a small community of enthusiasts into a huge, unique subculture. And as you may know, each subculture develops its own language. The crypto community is not an exception. Therefore, every trader should be quite familiar with its professional slang and in particular, basic trading terms. So today, we will discuss the most important crypto trading terms, which will help you gain some insight into crypto trading as a whole. Hey guys, Shad here with another new lesson for our beginner crypto traders, and today we will discuss the basic terminology of a crypto trader. So let's start simple. Who are bulls and bears? Bulls and bears are common names for market players. Bulls are traders who expect to benefit from an increase in an asset's price. They buy assets, keeping the uptrend going. When the price goes up, they sell the assets. The resulting difference is their profit. Bears, on the other hand, to the contrary, are traders who believe that the market or asset will go down. They earn money by buying assets on margin that is in debt. For example, a bear borrowed one Bitcoin and sold it for $50,000, hoping that the market will crash. When the forecast comes true and Bitcoin drops sharply to 40K, they buy Bitcoin back and return it to the lender. The difference of $10,000 therefore goes into their pocket. Bulls and bears create trends in the market, and depending on who dominates the market can be bullish or bearish. The market is bullish when there are more buyers than sellers and the prices seem to be increasing. Well, by buying assets, market players raise the price just like a bull raises its victim with his horns. The market is bearish when there are more sellers than buyers and prices start to fall. Bears are pushing the market further down and force prices to sag just like bears crush their prey with their paws. To determine which type of market you're currently in, traders use trend lines. This is the next term in our top list. Trend lines are a tool that can be used to help traders determine the current market trend, that is, the direction of which way the market is going. There are three types of trends which you should consider. An uptrend, or bullish trend. This trend shows that the price of cryptocurrency is rising. To identify an uptrend, you need to find a sequence of higher highs and higher lows on the chart. The line that connects the market lows is a trend line, also called a support line, because when the price of an asset reaches this line, it receives support and grows up again. Well, hopefully. Downtrend, or bearish trend, as you may have already guessed, this trend indicates a fall in the price. To identify a downtrend, you need to find a sequence of lower highs and lower lows on the chart. The line that connects the highs in the bearish trend is also called the resistance line, because when the price of an asset hits the resistance line, it meets resistance and falls down. Well, that's what the bears want. And finally, the third type is called a sideways trend, or flat. It shows that there are almost no price changes over a given period, it's stagnating. And to determine a sideways trend, you need to find a period upon which the chart, there is no definitive direction of price movement. It's not going up or down, it's just a sideways trend. And a resistance line limits the price rise, and a support line does not allow prices to decline. When a sideways trend ends or breaks, the price breaks either to the high or low, allowing some market players to make a solid profit. Identifying trend lines is the perfect way to choose which position to enter, a short or a long one. Long, or a long position, refers to the purchase of an asset in order to sell it at a higher price. Bulls play long. The strategy is quite simple. You buy an asset and hold it until the price reaches its peak and then sell it before the price starts falling. Short, or a short position, is the bear's favorite tactic. These traders hope for a drop in the asset price and borrow assets from a broker or an exchange. Then they sell these assets and wait for the price to fall. When the price eventually falls down, these traders buy the assets back at a lower price and return them to the lender. The difference is their profit. Bulls are also often called hodlers. So what is hodl? Whenever a trader say that they are hodling, it means that they are simply holding assets and hoping for their future growth of said assets. In fact, the word hodl itself was originally just a typo of the word hold, but this typo became very popular and is widely used today. Hodl, or hold on for dear life. The next term in our list is the order book. The order book is a list of all currently available buy and sell orders on the exchange. An order book reflects the sentiment of the traders as a whole. This term is also called DOM, or depth of market level 2, or you might even see open book. The order book has several zones. The red zone, also called ask, displays sell orders. Ask is the price at which the seller is willing to sell a certain amount of said asset. The green zone, also called bid, displays buy orders. Bid is the price at which the buyer is willing to buy a certain amount of said asset. And then finally, there's the neutral zone in the market, which is located within the spread. And the spread is simply the difference between the bid and the ask price of a currency pair. The order book helps traders decide when and which order to place. An order is a request sent to a broker or an exchange to sell or buy an asset. There are many types of orders, but the most popular are as follows. First, there's the market order, which is an order to buy or sell that is executed straight away at current market prices. The disadvantage of this order is that the final price of the transaction can differ significantly significantly from an expected price, especially during high price fluctuations. So to avoid this, many traders use what's called a limit order. A limit order is an order where you specify the exact price at which you are willing to buy or sell an asset, and unlike a market order, this one is executed only after the market price reaches the specified level. Another popular order type is a stop loss, or simply a stop order. While often neglected by beginner traders, this order is by all means the best way to limit potential losses. A stop order works in exactly the same way as a limit order, but in the opposite direction. So here, you always indicate a price that is worse than the current price you're buying or selling at, so that if you fail to predict the market movement, you can close the deal and fix your losses at a level that is acceptable for you and your bankroll. As soon as the market price reaches your stop loss price, a stop loss becomes a market order and your position is closed instantly at the current market rate. Earlier in this video, we talked about bulls and bears, but there are many other animals in the market jungles. So did you know, for example, what newcomers or simply inactive traders are called? They're called hamsters. Hamsters are real panic makers who are ready to buy or sell cryptocurrency when there is only a slight change in trends. And big market players who hold an impressive amount of assets and have immense trading experience are usually called whales. Such players can actually manipulate the market situation by buying and selling assets themselves, especially on low liquidity markets. Next, the following terms are what beginners need to get rid of to succeed in crypto trading. First is FUD, or fear, uncertainty, and doubt. There's FOMO, which is the fear of missing out. This is when, for instance, the price of a coin rises and you have the false feeling that it will soon grow further, so you buy in at a high price and you buy the top. And then there's weak hands, which is when an investor sells coins at the first sign of a price fall, or paper hands. Beginners should also never neglect risk management in order to guarantee maximum profit and minimize loss. Risk management in trading involves many aspects, including setting up stop orders, price alerts, and much more. The next terms in our top list are pump and dump. A pump is an artificial price rise that occurs when bulls are massively buying assets at relatively low prices. A dump, on the other hand, is an artificial price cut that occurs when bears are massively selling their assets. You have already learned plenty of new terms, but it's still not enough for successful trading. So to make profitable trades, you also need to have a thorough understanding of technical and fundamental analysis. Technical analysis is a set of tools and techniques that helps traders predict future price changes based on similar price changes in the past. It also includes all the analysis of price charts, chart patterns, and much more. Fundamental analysis is a method upon which you evaluate the value of an asset where both quantitative and qualitative factors are considered. So when carrying out fundamental analysis, a trader examines the financial, technical, and accounting reports of the blockchain, the project, and tries to find out the fair value of said token. There are a huge number of terms associated with technical and fundamental analysis. For now, we'll talk a little bit about the most important ones of them. Let's start with the term market cycle. So a market cycle is a broad term referring to trends of patterns that appear in different markets or business environments. A moving average, or MA, is a widely used technical indicator that helps determine a trend direction as well as the support and resistance zones. Simply put, a moving average is the average price of an asset over a given period. Then there's the relative strength index, which shows the momentum indicator used to measure the magnitude of recent price changes. It also helps to identify assets that are overbought or oversold. Then there's the stochastic oscillator, which is a popular technical indicator that helps traders understand where one trend ends and another one begins. This indicator compares the closing price of an asset to a range of prices over a given period. So as we've already discussed indicators in market analysis, now it's time to speak about coins. We all know that Bitcoin is the world's first cryptocurrency launched back in 2009, but what is an altcoin? Altcoins are all other cryptocurrencies apart from Bitcoin. They all appeared with the aim to become a better version of Bitcoin. But while there are plenty of altcoins on the market these days, Bitcoin is still the most popular and expensive crypto per unit. Crypto traders often use the term initial coin offering, or ICO. ICO is a virtually equivalent of an IPO, a public offering, where a company develops a new token and launches an ICO as a means to raise funds. Investors can then take part in the offering and receive a new token issued by said company. But before investing in any cryptocurrency, do not forget to analyze its potential. And a reputable market data site can help you with this, such as CoinMarketCap. It is undoubtedly one of the best resources for crypto asset analytics, so go to CMC and check it out. Another important aspect worth noticing when it comes to crypto is security, and one of the best ways to protect your account on the exchange is to use what's called two-factor authentication. 2FA, or two-factor authentication, generates a 6-digit code that is then sent to your mobile device. You have to enter this code to be able to log into your account or even send funds if you wish. This makes it almost impossible to hack your account, even if the attackers manage to get a hold of your password. Finally, I should tell you about margin trading, one of the most favorable strategies of avid investors. Margin trading is a type of trading where you use credit assets or funds from the exchange, broker, or another third party. Margin trading accounts give traders a unique opportunity to trade a large amount of assets and maximize profit from successful deals. Okay guys, these are all the basic terms you should know to start your trading career. So I'll see you soon, and remember one simple thing: knowledge is power, and knowledge in crypto trading is profit. So don't miss our next lessons on the basics of crypto trading. Bye bye for now.